Muted.
Joining us today. Oftentimes listening and talking about taxes can be kind of taxing, but I'm going to try to, at least on this webinar for an hour, make it a little more interesting so that not only do you walk away with ideas that you can use with your clients and in practice, but you can also walk away with some ideas for yourself as well when we're talking about some strategies to help reduce income taxes. It's always important to remember that we cannot evade taxes. Tax evasion is a crime. However, we can avoid taxes. And avoidance of taxes simply means that we use every available deduction or credit that is allowed to us based on our income, our filing status, and things like that, that we can to reduce our income to a point that is legitimate and low. That's kind of the way I like to look at it. So we're gonna dive into a number of areas here today. I know there's going to be a lot of questions because taxes often bring up a lot of what ifs. So we're going to hold questions and see how much time we have at the end because I really want to get through this information. I would feel disappointed if I didn't get through everything that I wanted to get through today because I took the time to answer some questions in the middle of it. So bear with me, and we're going to cover some information here that I think is pretty exciting stuff. I use it all the time, and when you hear some of my stories here, success stories about how I've reduced some of my clients' taxes, I think you're going to be, your eyes are going to be open here. So let's get started. It's really important to understand that a tax return is simply a summary of all of the taxable events that occurred in your life in the year before. And they give us a number of months, including extensions, then 9 months to record these particular events with the IRS. Now, the IRS already knows about some of these events because they've been given copies of your W-2s and your 1099s and things like that. However, the IRS does not have copies of things that you're deducting. They have some, like mortgage interest and property taxes, but things like charity, medical expenses, things like that, unless in miscellaneous deductions and credits, unless you keep track of it yourself through your paperwork and teach your clients how to handle their paperwork, the IRS really doesn't know what's going on in your life other than the pieces of paper that they've been given. So tax returns tend to be very predictable. They tend to be consistent. They are recurring because obviously we pay them every year, we file them every year, and irregularities or changes to a tax return must be explained. And often it's those irregularities from year to year that might trigger some sort of an audit. Normally it would be a requested documentation audit where something just doesn't match up according to the computer that's at us, and they want to kind of take a look and see who's correct. But we often lay, for comparison purposes, we lay our taxes out year by year. And actually, for this year, we looked at 2014 when we were preparing 2015. And when we're preparing 2015, or 16, we'll be looking at 2015. The reasons for that is that there are, for most Americans, there's a consistency and a predictability there where we know from year to year that there will be a W-2 from a certain company, unless it turns out that, let's say, they switch jobs, then that would be an irregularity and we'd have to have it explained. So there's a lot of story that goes on along with the numbers on your tax return. The hard data are the actual numbers, but the soft data is actually interpreting those numbers and interpreting the laws to your advantage and to your client's advantage. And a lot of these are just little known facts and factoids that I'm going to share with you today. Now, it's interesting to note that most people would agree it's a good idea to ensure that your federal tax return is as accurate as possible. But if you're concerned about being audited by the IRS, you may be worrying unnecessarily. And that's often a worry that people who haven't filed before or filed on their own, as opposed to jointly, they're very concerned about being audited. I think that's brought up in my office quite often. So it turns out for 2014, here are the latest numbers that I have for you. Of the 192 million tax returns that were filed in 2014, The IRS audited about 1.4 million, so it's 0.7%. And the vast majority of those audits, 3/4 of them were correspondence audits where somebody was missing, let's say, a 1099-B, proceeds from barter, from stock transactions. I just got one the other day where somebody left it off of their return, and the IRS has already sent a letter saying we received this 1099. It wasn't on your return. So most of the audits are of that particular nature. And they may ask you for records for things like charity and some other business items. But basically, the chances of being audited are very, very low. And a lot of that, as you're going to find, comes from a lack of man and woman power at the IRS. So you can always, again, let your clients know that particular statistic. Now, the first thing we're going to do today is just jump into actually understanding one of the most important concepts in taxes, and that is how we understand cost basis. And our clients do not understand cost basis, and attorneys often, more often than not, do not understand cost basis. And when we come in and we discuss cost basis of anything we're going to talk about here, I have 3 examples coming up, we are going to look like heroes because you might be saving a tax bill to your client of tens of thousands of dollars by understanding what the cost basis of a particular stock might be or an investment in a marital settlement. So this is actually the full-blown calculation, and like a stock cost basis is going to have some of these items. A real estate cost basis is going to have some of these items. Selling businesses will have a couple of them. So each one is different, but these are the 3 items that make up cost basis. And the first one is always going to be, what did you pay for the item, or what did you contribute? If it's rental real estate, you're going to find that you can add home improvements and purchase expenses, cost of purchase. If it's a stock, you can add in your commissions, things like that. If it's a business, you add in your business profit. And then from that particular calculation, we deduct things like depreciation, if it's applicable, cash distributions or withdrawals that were non-taxable in a business losses. So there are items here that, based on which item we decide to calculate our tax basis on, we're going to find that we will get some answers. Now, the first one we're going to talk about here is a simple stock sale. I'm going to say that this particular stock was purchased for $10,000. When you add the commission on that was paid to buy the stock, I'm sorry, that should say $10,020. That is my mistake. $10,020. So the stock basis is increased by the $20. Now, what's difficult about stock sales, and I just did one 2 weeks ago, I had a client who was buying Procter & Gamble through a payroll deduction for, I think about 30 years. We went back to 1992, I think it was. And they had every single statement. I could not believe it, every single statement. So I literally set up an Excel spreadsheet and went through and did every year and all the contributions that were made to that particular stock to purchase it. We did all the splits. We did all of the inheritances and things that were moved out of there, and we actually came up with a cost basis, an actual dollar amount number. It took about 3 spreadsheets and cost about $600 to do, but now this person knows that all of that stock that they bought over time, the basis was $18.80. And Procter & Gamble today sells somewhere between $60 and $70 a share. Now, if you don't want to go to that kind of detail, or somebody's missing a lot of statements, you can always go to something like Yahoo Finance, and there are historical charts now up on the net where you can actually put in the name of the ticker and the date that you particularly bought that stock, and they can start to give you a range over that time period what the average stock price would be. And we have had to resort to figuring out the average stock price. I don't have a specific website here for you, but I know that if you go to Yahoo Finance/history, it will lead you to it. You have to first get through the history of the indexes, and once you do, then you can get to a particular stock. But I will sometimes run that and pull it off and put it in my client's tax records as proof of the basis that I calculated. Now, another example where basis is hugely important is in the rental real estate area. If your client is receiving some rental real estate, then they have to be very careful about what sort of built-in gain or loss is going to come along or be associated with that piece of real estate. So for instance, in this particular case, I have a piece of property that was purchased for $100,000, and there was $3,000 to close it. Over the time that they held it, they put on home improvements of $50,000, and they had depreciation because they'd been renting it out for many years. Actually, they've been renting it out for over 20 years, and the depreciation was $73,000. So you can see I have a plus, a plus, a plus, and a minus to get to this cost basis, which is pretty typical in rental real estate. So in this particular case, if I sell this property at $150,000, then I don't have a gain. Somebody might say I bought it at $100, I sold it for $150, so I have a $50,000 gain, but that's not true. Because we calculated out the depreciation and that reduced the amount, then your cost basis at 80 says that your gain is 70,000 now, not 50,000. So I often will start to try to calculate some basis on some of the bigger numbers in my clients' marital settlements, because if my clients are walking away with investments that are liquid, that may have some tax consequences long term, I think the client is entitled to understand, at least generally, what those tax ramifications might be if they choose that particular item. Oftentimes, even on a house sale, the discussion, if the closing costs are $20,000 or $30,000, some discussion occurs before the divorce as to let's sell the house now and we'll split the closing costs. Because often, once one of the parties receives that home in the settlement, then when they choose to sell it on their time frame, they're going to get whopped with the entire set of closing costs. So these are big numbers for people, and these kinds of swings in their marital settlement can either make them or break them over time, depending on how many types of items they have here that might have basis. Now the third item here is really if we're going to be selling a business as part of a divorce. So let's say that the contribution was $250,000, a marital contribution to the business, and there was an annual profit of $50,000, but someone had also taken out some cash distributions or withdrawals that were not taxable of $30,000. Whenever someone is taking out distributions or withdrawals from a K-1 that are not taxable, then they actually go to reduce your basis. That's what's happening in this illustration. The other way those distributions could have been handled might have been through a bonus situation where they would have gone through payroll and withholding and been part of the taxable equation, or through wages or whatever. But when someone takes it as a separate distribution on a K-1, then it's going to be deemed as reduction of basis. Sometimes I've also seen this as an amount that's then added to the loans from shareholders category as well. But that's a whole nother webinar on corporations, which we might follow up with later on in the year or early next year. We'll see. Corporations have lots and lots of information there that are necessary to really make sure that you're helping your clients decipher all their numbers. So when we look at businesses then, in this particular case, because the profit was bigger than the distribution, now the basis is $270,000. So if they were to sell their partnership share, again, there could be a gain or loss depending on whether it's greater or lesser than $270,000. Now, this is an area that I'm always called upon to write reports about, because a lot of people and a lot of our clients believe that the income that they see on their tax return is their income. And that's not really true. I call it true income. Some people call it taxable income plus cash flow. But whatever you want to call it, they are items that do not show up on your tax return to the full extent that they are taxable. So sometimes people don't include them as part of the income coming into the household, but it is deemed to be income. So the first one we're going to talk about here is Social Security. As you know, only up to 85% of the Social Security that anybody receives is taxable, and that is an item that is phased up based on thresholds. So you're not going to see all of the Social Security that's coming in the taxable area of the tax return, because it's just not all taxed. Child support, as we know, is not taxable. That will not show up on a tax return. But when it comes to cash flow, for many families, it's a viable part of the family's support. Rental income shows up on the tax return, but the net rental income is what's taxed. And that net rental income could include something like this next item, depreciation, which is actually a non-cash expense. Somebody may be depreciating a rental property and writing off $5,000 or $7,000 a year against the income from the rental to make the actual net rental income a negative. And I go back and I rework these numbers and I take that depreciation out of there because it's a non-cash item. It's not really something somebody put money out for. So I'm going to go ahead and take it out and recalculate my rental income just based on actual expenses. So again, there's an area there that could have plus or minus cash flow depending on how the numbers work out. And as I just mentioned on the previous slide, business distributions are also included in cash flow. Even if they don't show up in the tax return, it's still money that was given to that particular partner or shareholder, and they took a check. So there is a distribution of cash there. And then tax-free income, municipal bonds, that also does not show up on the tax return, with the exception of it shows up in an information actual calculation itself. So these are items that I would just again say, if you run across any of these, you know that the income on the tax return is not the actual income that you are looking at. You may need to do some pluses and minuses to get what would be known as the true income or the true cash flow for that particular family. And when it comes to, there's a couple areas here. You will find, and it's kind of interesting, I do a lot of searches where I'm looking for money that's hidden or missing. And the couple things you're not going to find on a tax return is often where money might be parked, which would be an annuity, cash value life insurance, or some sort of a qualified retirement plan that's not taking distributions yet. So I always have to ask in particular about annuities, because except for the quarterly or annual statement, they don't show up anywhere until you start to take distributions. The cash value life insurance, again, is another area that doesn't show up on the tax return that I always ask about, as well as any money in qualified plans, IRAs, HSAs, whatever it might be. Some of those show up, some of those do not. So it's, again, always looking to find out where all the cash flow and the income is coming from. Now, when we look at a copy of a 1040 here, what we're really looking at, and these are two of my favorite clients, Jim Shue and Penny Loafer. This is a very typical type of a return that I would prepare. I do about 120 returns a year. And you'll notice that there are some wages, and there's a business, and there's a capital gain, capital loss carry forward going on. They own some rental real estate, which, surprises, is at a loss, probably because of the depreciation. There's some gambling winnings on here, which we're going to talk about in a little while, and quite a bit of interest in today's low interest environment, interest income and dividends. So this is pretty typical of what I would see. So you might say that, well, then their income is, you know, at the bottom of the page, adjusted gross is 94. But remember, that's simply just the adjusted taxable gross income. I wish they'd put the word taxable in there, but they don't. They just call it AGI. And then on the second page, this person went ahead and took my advice and looked for as many possible itemized deductions as they could, which we'll talk about. And so they are able to write almost $34,000 off of their $94,000 income. And this is an area where you can actually help clients, and we'll talk about that on the next page, understand what they might be able to deduct there. And that brought them down to $60,000. and each exemption this year was worth $4,000, so that brought them down to 52. So they did a nice job of managing their taxes. They only paid $6,400 in taxes plus a little self-employment, and they had withheld $10,000, so they're getting $4,000 back. They would not be getting $4,000 back if they did not itemize those deductions and they just stuck with the standard. I think the standard, I don't know, somewhere around $12,000 or $14,000 for a couple. We can check all the numbers. We're here just to talk about the theory. So by understanding and explaining to clients what itemized deductions are, you will help them tremendously in helping them understand. I think most people understand that property taxes are deductible as well as mortgage interest. However, there are a lot of other items here, and at the back of this session, I hope everyone's going to be able to get a copy of this, because I have 6 pages of itemized deductions there that are just going to surprise you as to the latitude of things that you're allowed to deduct. So in this particular client, Jim Shoe and Penny Loafer, they had medical expenses. And now we know that the medical threshold went up. Unless you're over 65, then you can you're still at 7.5%. You have to climb over before you can deduct anything. Anyone younger than that, it's 10% now. So you can see they were over the 9442, so we're still able to deduct $3,267. Great. They're able to take off their income taxes, whether they paid them by estimated payment voucher or by payroll withholding, their real estate taxes and mortgage interest. They're able to write off their charity, always an important area for people, and I always stress this with people is whenever they ask me how they can lower their tax bill, that's the first thing I say is give more to charity. And some do and some don't, but it's a very viable way to reduce your taxes. And as you can give up to 50% of your adjusted gross income to charity. So in particular years for a lot of clients, it makes a lot of sense to reduce their taxes this way. And then we're going to talk about miscellaneous deductions and things here that are subject to the 2% threshold. There's lots and lots of things that can be written off in the miscellaneous deduction item, and we're going to talk about a few of those in particular which save people tens of thousands of dollars. And then at the bottom here are the gambling losses. Remember, we can only write off gambling losses to the extent of winnings, and the winnings on the first page were, there we go, $1,200. So even if this person ended up losing $1,800, $2,000, $5,000, we're still only allowed to write off the $1,200. I would caution you, however, that if you do see somebody who has gambling losses or has statements from casinos, do not believe those. Those are not IRS statements, and they do not reflect the true value of what those gambling losses might be. I had a client this year who had gambling winnings of about $64,000, and it showed on the statements from the casinos that he only spent $48,000. And when he added them all up and he went home and looked at all his ATMs and all of his card items, it turned out he spent $94,000. So we were able to wipe out every gambling winning he had with the gambling losses, but it was only because he kept track of them. And again, if you have clients who do gambling, please make sure just to explain to them, keep track of those losses, because you might, at the end of the year, if you have a big winning, you might be able to use them. Now, I love Schedule B. I love, love, love Schedule B. I know you're thinking, well, all it is listing out, interest and dividends. But for me, when I'm looking for money that's or hidden accounts or missing accounts, this form can be golden. It's going to show me where all the where all the interest is coming from. It's going to show me where all the dividends are coming from. And at the bottom, what you're going to notice is I did not fill in the fact that they had I had to ask them if they have a signature in a foreign bank account or a foreign trust. And in this particular case, I left that blank, but you can see that I've got to ask them that. I know why. I left it blank because I didn't e-file this. This was just a sample I made. If I were to try to e-file this return without answering these questions, it would not file. So every taxpayer has got to account for the fact if they had over $1,500 of interest or dividends, then they have to say yes or no to these particular questions. And I often have clients say yes, they have foreign bank accounts or foreign trusts, especially if they lived in another country. So this is a very, very important area of Schedule 1040. I always find a lot of information out on this, and it's pretty shocking sometimes what you might find out of where people have hidden some money. Now, Schedule C, a lot of us are familiar with Schedule Cs. In this case, it's Penny Loafer, and she does reflexology. A Schedule C is wonderful. If you own your own business, if you have clients who are dabbling in businesses, please have them file a Schedule C. You need to have an intent to make profit, however, and you can't write off hobbies. But there's now even a safe harbor for home office use that I've used here on line 30. You don't even have to put down the expenses for using your home anymore. You just do a square footage and they give you a certain dollar amount and you're done. So Schedule C is also used not just for a sole proprietor, but also for an LLC, a limited liability company, when you have one member. So for instance, I am a one-member LLC, so I still do I'm a one-member LLC, that's right. So I still file a Schedule C. If there were two members in the LLC, then we would have to file a partnership return, okay? So just because somebody has a Schedule C does not mean that they're not, that they don't have an LLC. They just have to file it on this particular form. And we could do a whole seminar, a whole webinar on businesses, so we'll leave that for later. Anything else on here I want to talk about? No, we often find items that look out of place or that look unusually large for a particular category, and we might request information on those particular deductions and expenses. And also, if I see all the numbers are even, I know that probably they're just being made up, and I would challenge those numbers. So there's just a couple little tricks when you're looking at some of this that you want to make sure that everything looks appropriate for the type of business that it is. And if your clients are starting a business, going through the divorce, it's good for them to get familiar with this particular form. All right, and then we have a couple supporting schedules here. In this case, we wrote off some investment advisory fees, a safe deposit box, and some investment supplies. That could have been newspapers, software, anything like that. And because they were able to write off some medical, you can see here that we've got prescriptions, vision, dental, therapy, health insurance premiums, long-term care, and medical miles as well. 23 cents per medical mile. Now, I know you're going to have to look at these like you're on a ship here because they faxed a little bit on the slanted side. But this is important information. This is really something that I got from a tax seminar that I went to. I am always extremely worried about looking at alimony and trying to match up the person who's paying with the person who's receiving. And 9 times out of 10, I have found there are discrepancies between those two numbers. And then when I started to read what the IRS has found, I wasn't surprised because I'm finding the same results. So, believe it or not, the claimed deductions for alimony exceed the income being included. And that should be no surprise there at all. And here's what they said. The latest year that they had to report was 2014. And I'm sorry, in 2014, the report was for 2010 tax returns. They looked at 567,000 plus returns where alimony deductions were claimed, and only 47% of the recipient returns were reported, and they did not match the, excuse me, let me start over on that one. This is just a lot of gobbledygook here. They looked at over 500,000 returns, and what they found was that 47% of the returns did not match what the payor, the deductors, were taking on their tax returns. So here's what it is in numbers. The alimony deductions on the tax returns are $4.3 billion, and the alimony income was only $2.3 billion. And they're saying a lot of that is simply because the tax ID number was either missing or not valid. They were trying to determine, how to match these things up. But apart from, like it says here, examining a small number of returns, the IRS has no process to address this reporting gap. So it goes on and on to say that, they only are looking at particular returns that are above a certain undisclosed amount. So that prevented them from looking at 77,000 of the 260,000 that they were examining. And then it went down even further. So what it turned out after all of this, with respect to 500,000 returns, only 10,870 were selected for examination. So this is not as big a deal as I always thought it was, and I do try to get them as close as possible. So by talking again about the requirements for alimony, and these are the actual requirements from the IRS code, that the payments must be made in cash. It must be paid under a divorce or separation instrument, and we're going to talk about that. That's the important feature here. It can't be designated as not includable. They might not be members of the same household. If the payee dies, there's no liability to make another payment, and it may not be disguised child support. Now, I find that B is the one that causes most of the discrepancies between what I see being added and what I see being deducted on tax returns. If a tax return says that I'm paying you $4,000 a month, then you are going to take $4,000 a month and put it into income, and I'm going to deduct it. If, let's say, I'm given inheritance and I'm just a nice person and I decide just to give you an extra $10,000, that is not considered alimony. The only things considered alimony for the purposes of including it in income are those items that are put in the divorce decree themselves. So that could be a flat dollar amount every year, or it could be a sliding scale based on the maintenance formulas in your particular states. And it also would include any true-ups. I do a number of true-ups each year just to make sure that the amount that is being paid is the amount that's really being paid. But it's all based on what the divorce decree says for me on how I'm supposed to handle the alimony. It's a very important point. Only the money that's in the divorce decree is the one that gets put on the tax return. So I had a woman once who came in here, and she had about $75,000 in alimony he put down. And then when we got his tax return, he noticed he only put $42,000 down. And I said, there's like a $30,000+ amount difference between the two of you. She had been including all kinds of checks he was giving her, and she was paying taxes on everything. He would just give her extra money, and she'd be paying taxes on it because she recorded all the checks. So when we actually went back to her decree to see what it said, we were able to amend her tax return, get her back down to the $42,000 where she should have been to begin with, and then she got a refund, I think 3 or 4 years in a row she did that, of $6,000 or $7,000 each year because she'd overpaid on her alimony. So again, this is an area that you really want to make sure your clients understand what they need to pay taxes on, and then we're also going to talk about how they need to pay taxes. You need to get your clients informed on how to make estimated tax payments. We know they're quarterly. A lot of you probably make them. I do too. Not my favorite day of the month. But this is the only way that the IRS is going to get money unless you're an employee and you have it withheld. In this particular case, our clients have got to start to do this from the first maintenance check they receive so that they get into the rhythm of paying these quarterly. The worst thing that can happen, and I've seen it, and you probably have too, is a client gets the maintenance money and they know they have to pay taxes sometime next year, and I'm doing quotes on that. So they spend all their maintenance money. I can't tell you how often I've seen this. And then I go to do their taxes the next year and they're like, oh, I didn't know I was going to owe all of this money. It's all gone. So not only now do they owe all the money from the year before, which they've spent, but now they should start making payments for this current year as well, and there's no money there. They didn't understand from the beginning that they needed to siphon off 15 or 20 or 30% from every maintenance check that they get and put it into their IRS checking account or some other kind of a tax file so that when these quarterly payments come up, they have the money there to pay them. And we know they're not quarterly, but there are 4 in 1 year. April 18th was the first one. June 15th, coming up in a month, is the second one. And then September 15th, and then January of the following year. So it's always important to really get them to understand and actually give them a copy of what one of these look like, because they're normally not going to be getting a new accountant until sometime later in the year. And by then, it's already almost too late. We have to get them started on understanding check number 1, you're going to put part of it away and you're not going to touch it. And that's how they start to learn to live within their means. So estimated tax vouchers are very important when you're paying maintenance. Now here's one of my favorite items, and this is where I just, there are so many attorneys and judges and clients who don't understand this particular part of the miscellaneous itemized deductions. We are going to be talking about income-related legal fees. And what this is, and I took this right from the tax code, is you can deduct the ordinary and necessary expenses that you pay subject to the 2% limit, which we talked about because these are itemized miscellaneous deductions. You can deduct investment fees and expenses, legal fees related to producing or collecting taxable income or getting tax advice, and tax advice fees. So let's do the easy ones first. Tax advice fees are going to be things like tax preparation, you know, buying TurboTax, going to somebody and getting their cost basis calculated like that woman did with me, looking for some tax planning. All those things related to taxes are all deductible subject to the 2% limit. Same thing with investment fees and expenses. When you have investment fees or management fees that you can deduct, when you have safe deposit boxes, and you're going to see there's a whole list of expenses that you can write off, publications and journals and things. But the big one I think would be investment advisory fees. And the third one that we're going to talk about some more are legal fees related to producing or collecting taxable income or getting tax advice. This is major. Every one of my clients just can't believe how much of their legal fees I can get them back if we just go about this the proper way. So I have a little case study here, and this was a real case study. This was last December. And this was a woman who paid, during that tax year, $140,000 in legal fees for her divorce. And in my particular case here, the divorce was final on December 15th, let's say, and she was going to start her alimony, believe it or not, right on time, January 1st of this year. Now, had she paid, and she didn't get any alimony last year, 2015, and she had no income other than a little bit of dividends and interest, nothing to amount to very much. Now, had she not come to me and we talked about this, even if she would have taken part of her legal fees and been able to deduct them last year, had she paid them, she would have gotten no benefit from paying that $140,000 in 2015, none at all, because she had nothing at all to write these legal fees against. So here's what the attorney and I did. I have a letter from the attorney in her file, because these are some pretty big numbers, and he's a fancy schmancy downtown Chicago attorney. And this was just 1 year of a four-year divorce, I might add. There was $100,000 of the $140,000 that he said was related to child support and property settlement issues. And he said, yeah, out of the $140,000 for last year, about $40,000 was tied to discussions surrounding alimony. So here's what we did. He agreed on December 15th to take a check for $100,000 from my client because it didn't matter. None of that would involve her taxes at all anyways. However, the other $40,000, she went ahead and she paid it in 2016. And because of that, we're going to be able to write it off against her maintenance, which is probably going to be about $130,000, $140,000 this year. So what we did was we saved her this year about $8,500 in income taxes, in federal taxes, because this is deemed to be income-related legal fees. Only legal fees that are related to the manufacture of income can be treated this way. So if you have a lawsuit, let's say another example might be a lawsuit involving back pay of a company, and that back pay would have been taxable salary to you, then those legal fees would also be deductible because you're in court fighting about a taxable event. The same thing with divorce. The alimony part of the divorce is a taxable event. Child support and property settlements are not. So what we're doing here is we're taking advantage of the rule that says, let's figure out how much of these legal fees are deductible and place them in the year where we can, get a deduction for them that's meaningful to my client. Now, in this particular, I had the attorney write a letter. I often look at the bills and ahead of time, if I can get in at the beginning of a case, I will instruct the attorney, please, when you're writing out your bills for the client every month, will you please stress if this was a maintenance meeting or a maintenance call or anything about alimony versus, child support or property settlement. And if I could get them trained from the beginning, we can kind of go through and add it all up and then figure out how much of it was for each particular item. I mean, some cases are just property settlement. There's not a lot of income to be going around, and there may not be any alimony. So in that case, there are no legal fees to be had. Nobody's going to be able to deduct anything. And you can only the person who's receiving the alimony can pay the legal fees. Okay, the person who's deducting the alimony does not get this benefit because they're not producing income. They're actually reducing income. They're not producing, they're reducing. So it's only the client who's receiving the maintenance where it's important that the attorneys write up the bill so that it looks as if, we know what percentage of their bill can be written off. And actually the clients really like this. The attorneys, once I get them trained, understand the rule, and they're more than willing to go along with it because it helps their client, get a net tax bill and reduces their taxes as well as gets their bill paid. So this is a really important concept, I think, is to understand income-related legal fees and see how you can take this in your practice and explain to clients what it's all about. And I already know you're going to be getting a copy of the next 5 pages, so I'm not going to go through and bore you and read all of this information here. But what I'm going to talk about here are all these different types of items that can actually be, for instance, first are all of the deductible medical expenses. And a lot of them, all we really think about is vision, dental, medical. But when you start to look at all the other items here, and I often give a list of these to my clients as well. This came right out of the Publication 529 with the IRS miscellaneous deductions. And if you've never gone to the IRS website, it's a pretty good website. Don't let it scare you that it's the IRS. It's irs.gov. And if you go to Publication 529 and you have any questions about any of these, they actually explain them all as well. So not only do you get a list of them, but they also explain what they mean when they say, laboratory fees or, drug addiction or diagnostic services, whatever it might be. Okay, so we've got deductible medical expenses, and we've got more deductible medical expenses. And again, quite a few items here. We don't need to read them right now, but you'll be getting a copy of them. Now, what medical expenses are not included? Often it's important to know what you can't deduct as opposed to what you can deduct. So there's a whole list here as well of items that are not deductible, including funeral expenses. That's something that a lot of people often ask me about. Those are not deductible. Teeth whitening and anything for pets, not deductible. Now, when we look at what's subject to the 2% limit, these are all types of items that you now can deduct subject to that 2% threshold. So there's a whole list for unreimbursed employee business expenses, things that your employer doesn't pay for you, but you pay out of your pocket. Could be entertainment, travel, dues, You know, educator expenses seem to be a big one. Job search, if you buy tools and shoes and work boots and, you know, software, whatever it might be, if you're not being reimbursed for it, then you could go ahead and add it all up and write it off here. Tax preparation fees, and then we have other expenses as well. And some of these have more internal limits, but again, it just gives you a good little quick list of everything here that you might be allowed to deduct. And then it goes on to the next page. Investment fees, we talked about that. Legal fees, loss on deposits, repaying Social Security, safety deposit boxes. And of course, we all know that any fees paid for an IRA, if they take the money directly out of the IRA to pay the fee, it is not deductible, but if it is paid separately, it is deductible. I have some clients who prefer to take their RIA fees for their investments. They prefer to pay separately out of their IRAs, which means that not only will their money continue to grow tax deferred, but then they get a deduction for the fees that they're paying as well. So lots of things here to help people reduce their income. Now, there are some deductions that are not subject to the 2%, and one of those is the gambling losses we talked about. Unrecovered investment in annuities, things like this. Just a lot of miscellaneous kinds of things. Excuse me. Losses from Ponzi schemes. And then there's a whole series of non-deductible expenses. And this is where people keep asking me if they can write these off. You know, can I write off preparation of my will? I think every person who comes in here asks me that. Can I write off my estates and my trust work? And the answer is no. That's all deemed to be personal. Car license, dog licenses, none of this is deductible. Disability insurance, sorry, if you're paying your own policy, it's not deductible. But then remember, when you go to collect it, it's not taxable either. So again, I like clients to kind of get a sense of what kinds of deductions they have within their control, so that they can start to see, you know, they can start to plan things and understand how paperwork works and what they need to get together for their taxes. And if you could even take the time to just take them through a very brief, oh, here's some more that are not deductible. If you could take the time to just take them through a very brief sample 1040, so that you can explain to them, you know, based on if you have a job, here's what you're going to be looking for, here's information in January that you should be receiving from various places. Some people just have never handled the finances, and they are clueless when it comes to the paperwork. So the more we can help them get their tax paperwork in order and to understand that they need to keep things at least 3 years, that they need to keep confirmations from trades, that they need to keep deeds and trusts and wills, you know, in a safe deposit box, and sort of help them with this one particular area, I think you're going to find that they're going to be very appreciative, because this is something that I think we all just take for granted, is we get our taxes done. But if you've never done them and you don't have any idea how to start, it's a very daunting task. And of course, we know that 80% of all tax returns are done professionally now, and almost probably about the last 18% are done by TurboTaxes and people, you know, doing their own, and then 2% is still done manually. And if you want, the IRS will also do your taxes for you, but you won't get benefit for any of these extra deductions or anything. All they're going to do is look at all the pieces of paper that came in for you, and they're going to put it in and give you a tax to pay. So that's my least favorite way of doing taxes, but they will do it for you. Oh, I have 2 cute little jokes here, and then I have one more area on basis that an item here that I didn't cover yet, and then we'll have some time here, a few minutes for questions. Okay, we're talking about basis previously. There are 5 items that basis does not really apply to. And this is always really important for clients when they understand they don't have to keep track of basis in these particular areas. The first one is annuities. You do not have to keep track of your basis in an annuity. The annuity company will keep track of it for you. An IRA or qualified plan, things lose, that there is no such such idea as basis in an IRA or qualified plan. It all just comes out as distribution. When you are giving stocks to charity, you don't have to worry at all about your basis because it's not a sale and then giving the gift to charity. If you're giving stocks or mutual funds or investments directly to a charity, then you don't have to, you get a tax deduction for the fair market value of the stock today. You don't have to worry at all about basis, and the charity gets the stock tax-free. So I'm often encouraging clients, as a really good way to save money, is don't give dollars to charity, give them stocks. At every mutual fund, Fidelity, Vanguard, they will all just set it up for you. I have clients who routinely, and you can do as little as, you can tell clients 10 or 15 or 20 shares of stock. It doesn't have to be big, massive amounts. And they get, I don't know, $5,000, $6,000, $7,000 a year in charity write-offs against their taxes, and they blow off their capital gain, so there'll never be any basis issues because it's going straight to charity. Inheritance, where you get a step up in basis. Remember that at that point, when you receive inherited money, all the basis, all the gains for the past years are gone, and you get that step up to the date of death. And gifts, you inherit the basis from the person who is giving you the gift. So when I was just working with my Procter & Gamble people here a few weeks ago, he had been gifting 100 shares of stock every year to his daughter, so I had to actually calculate out her basis as well, based on the time, you know, when she was receiving those gifts, what it was worth in his portfolio. So if you're going to be gifting stock to anybody, or your clients will be gifting stock or investments, they need to gift that original basis along with it. Otherwise, people will be clueless when they go to sell it of what their gain or loss. So I think that that's all that I had to say today. Why don't we open it up for some questions? And we have 4 or 5 minutes.
Cool. We have had a few questions come in.
Okay.
From Rob, he asks, if someone has a foreign bank account, investment account, or trust, is the income required to be included on the U.S. tax returns?
Oh, that's a maybe. It all depends. For instance, I have a client who gets Canadian income from a farm, and that's included. But I have other clients who have trusts that are offshore that is not included, but they have to file a special report on the ones that are not included on their tax return. A FINRA report, I believe it's called. So again, that all depends on what type of income it is and where it is.
Alrighty. We had, going back to legal fees, Monica asks, if the income-related settlement is deemed unallocated family support, effectively lumps the child support with the alimony, can that portion of the legal fees be fully deducted?
That is an excellent question, and the answer all depends. As long as they're including it into income, which you would, then yes. Unallocated family support is deemed to be taxable.
Alrighty. And then I think we have time for maybe one more. If there is a temporary maintenance agreement in place, is that income reportable?
And again, that depends if the two are living together or not. You have to go back to some of those maintenance issues. Normally, we find temporary maintenance is not taxable because it's not a final decree or separation agreement.
Alrighty. And let's do one more, and then we'll batch all the rest of the questions and send them over to Peggy later. From Madeline, we have, if a client has the family home appraised in deciding whether to keep the house, is the appraisal fee deductible?
Yes. Yes, that's all part of the cost of selling, or the cost of the cost of valuing that particular investment. Yes.
Easy enough. I think that's all the time that we have right now. We do have a few more questions, but like I said, we will batch them up and send them to Peggy so that she can see them and respond to them. Unless you have any other final thoughts or anything, then I think that it's been a great webinar, a great presentation, and we really appreciate it.
All right, thank you so much, and I hope everybody took away some nugget of gold here that they can work with for either themselves or their clients. Okay, 10-4.
All right, thank you.
All right, thank you so much. Have a great day, everybody.